So moving into Chapter 22. Chapter 22 discusses the different procedures used to report accounting changes and error corrections, the use of estimates in accounting, as well as uncertainty that often surrounds some of the events that accountants attempt to measure, may result in the need for adjustments in the financial reporting process. The accurate reporting of these adjustments in a manner that facilitates analysis and understanding of financial statements is really the focus of this chapter. After studying this chapter, you should be able to identify types of accounting changes and understand the accounting for changes in accounting principles. Describe the accounting for changes in estimates and the changes in the reporting entity. Describe the accounting for correction of errors, and analyze the effects of those errors. FASB has standardized the manner in which accounting changes are reported. There are three types of accounting changes. Changes in accounting policy, which is a change from one generally accepted accounting principle to the other. So, for example, a change from LIFO to average cost. Change in accounting estimates. That's a change that occurs as a result of new information or an additional experience. An example for that would be a change in the estimate of the useful life of depreciable assets. And then a change in the reporting entity. A change from reporting as one type of entity to another type of entity. So an example of this is a change of specific subsidiaries comprising the group of companies for which consolidated financial statements are prepared. Errors are not considered an accounting change. Financial statement errors result from mathematical mistakes, mistakes in applying accounting principles, or oversight or misuse of facts that existed when preparing financial statements. So change from one accepting accounting policy to another. Examples of these are a change from average cost to LIFO, or from completed contract to percentage of completion methods. The adoption of a new principle in the recognition of events that have occurred for the first time or that were previously immaterial is not an accounting change. Changes from one generally accepted accounting principle to another are defined as a change in accounting principle. A company wishing to change from one principle to another must disclose the nature of and the reasons for the change in the principle and the explanation of why the newly adopted accounting principle is preferable. So yes, you can make changes. You have to be able to justify it. So the change in an accounting principle is not considered to result from the adoption of a new one in the recognition of events that have occurred for the first time or things that were previously immaterial. An example of this is implementing a credit sales policy when one had not previously existed is not considered a change in accounting principle. Also, a change from an accounting principle that is not acceptable to a principle that reflects GAAP is actually considered a correction of an error. There are three approaches that are used for recording the effect of changes in accounting principles. The report changes currently. The report changes retrospectively, meaning it goes backwards. And the report changes prospectively into the future. FASB requires that companies use the retrospective approach. Then users can better compare results from one period to the next. Reporting a change in accounting principles currently requires reporting the cumulative effect of the change in the financial statements in the current year's income statement as an irregular item. Advocates of this method contend that investors' confidence is lost by a retroactive adjustment of financial statements for prior periods. Retrospective application refers to the change of a different accounting principle to recast previously issued financial statements as if the new principle had always been used. The company shows any cumulative effect of the change as an adjustment to the beginning retained earnings of the earliest years that are presented. This approach will adjust the carrying amounts of assets and liabilities as of the beginning of the year. Any part of the cumulative effect attributable to the years prior to those presented is treated as an adjustment of beginning retained earnings of the earliest year presented. So let's look at a retrospective accounting change in regards to long-term contracts. These should still be relatively fresh in your mind. Denson Company has accounted for its income from long-term construction contracts using the completed contract method. In 2017, the company changed to the percentage of completion method. Management believes that this approach provides a more appropriate measure of the income earned. For tax purposes, the company uses the completed contract method and plans to continue doing so in the future. We're going to assume a 40% enacted tax rate. So we have what 2015, 2016, and 2017 schedules for the income statement utilizing the completed contract method. We then have the percentage of completion method and what the income would be underneath that situation. So the data we would use for retrospective is that we would need to take the difference between the percentage of completion and the completed contract method, net of tax. So we would have $220,000 that we would add to our construction and process. We would have an $88,000 deferred tax liability, and then an income effect net of tax posting to our retained earnings of $132,000. This is for the differences that had occurred. So if we look at the total at the beginning of 2017, that is going to tie back to these totals. When there is a change in accounting principle, the company has to disclose the nature of and the reason for the change in the accounting principle, and an explanation of why this new adopted accounting principle is preferable. They have to justify it. The method of applying the change, and a description of the prior period information that has been retrospectively adjusted, the effect of the change on income from continuing operations, net income, any other affected line item, and any affected per share amounts for the current period and for any prior periods that were retrospectively adjusted. The cumulative effect of the change on retained earnings or other components of equity or net assets in the statement of financial positions as of the beginning of the earliest period presented. Here we have a note regarding the change in the method of accounting for long-term contracts. This may also be accompanied by an additional chart or a schedule. Here we're showing what the disclosure would be for the retained earnings adjustment. And here you can see how it is disclosed on the retained earnings statement. Here again, we have a change in principle on long-term contracts for Pam Erickson Construction Company, who changed from the completed contract to the percentage of completed method of accounting for long-term construction contracts during 2018. For tax purposes, the company employs the completed contract method and will continue this approach in the future. We'll use the deferred tax liability for tax consequences of the change. And we have differences of $190,000 in 2017 and then $220,000 in 2018. Here's your pre-tax income at a tax rate of 35%. I want you to go ahead and hit pause and determine what entries are necessary to adjust the accounting records for the change in the accounting principle. What is the amount of net income and retained earnings that would be reported in 2018? Let's assume the beginning retained earnings for 2017 was $100,000. Once you have worked through this, I want you to go ahead and press play again, and the following slides will have the answers. So we have a difference of $190,000 from 2017 with a tax effect of $66,500. This means net of tax, the change would be $123,500. 2018 differences is $220,000 with a tax effect of $77,000 and net of tax of $143,000. So the journal entry that would be recorded in 2018, because we are addressing what occurred retrospectively, is construction in process of $190,000. Deferred tax liability is $66,500, and a retained earnings adjustment of $123,500. Pre-tax income for 2018, for restated for 2017, would be $780,000, with income tax at $273,000, or net income of $507,000. Beginning retained earnings is $100,000. We'd have net income of $507,000. So we'd have new ending retained earnings of $607,000. Pre-tax income is $700,000 for 2018. We have $245,000 of income tax associated with that. $455,000 of net income. We are starting with $483,500. That's this previous here. We have the accounting change of $123,500, giving us a new beginning retained earnings of the $607,000 here underneath the restated. We had net income of $455,000. That's going to give us retained earnings of $1,062,000. When a company makes a change in accounting principle, FASB takes the position that all direct effects should be presented retrospectively. but those that are indirect should not be shown retrospectively. The indirect effects are reported only in the current period. When a company cannot determine the prior period effects using every reasonable effort to do so, it is considered impracticable, and the company should not use retrospective application. If any of the following conditions exist, a company should not use retrospective application. The company cannot determine the effects of the retrospective application. Retrospective application requires assumptions about management's intent in a prior period. Retrospective application requires significant estimates for a prior period, and the company cannot objectively verify the necessary information to develop these estimates. If any of these conditions exist, the company prospectively applies the new accounting principle. The company must disclose the effect of the impracticable change on the results of the operations in the period of change, and explain the reasons for omitting the computations of the cumulative effect for prior years, and disclose the justification for the change. Next, we're going to talk about the accounting for changes in estimates and changes in reporting entities. FASB requires that changes in estimates, so for example, uncollectible receivables, inventory obsolescence, useful lives and salvage values regarding the assets, periods benefited by deferred costs, liabilities for warranty costs and income taxes, recoverable mineral reserves, changes in depreciation methods, all of these involve estimates. And something may happen that we would have a change in that. When there is a change in the estimate, that should be handled prospectively. Opening balances are not adjusted, and there is no attempt made to catch up for prior periods. The effects of all changes in estimates are accounted for in the period of change if the change affects that period only, or the period of change and future periods if the change affects both. FASB views changes in estimates as normal, recurring corrections and adjustments, and absolutely prohibits retrospective treatment for them. So let's look at Arcadia High School, who purchased equipment for $510,000, which had an estimated useful life of 10 years and a salvage value of $10,000 at the end of that time. Depreciation has been recorded for 7 years on a straight line basis. In 2017, which is year 8, it's determined that the total estimated life should be 15 years with a salvage value of $5,000 at the end of that time. What is the journal entry to record the prior year's depreciation expense? And they ask that we calculate the depreciation expense for 2017. So there is no entry to record the prior year's depreciation expense because it happens in the current period and then prospectively. It does not happen retrospectively. So let's calculate the depreciation expense for 2017. Equipment originally cost $510,000. Had a salvage value of $10,000, so that gave us a depreciable base of $500,000 for a 10-year estimated useful life. That's $50,000 a year and 7 years of depreciation that has occurred. So we currently have a net book value of $160,000. With a net book value of $160,000 and a salvage value of $5,000, that gives us a depreciable base for the remaining economic life of the asset of $155,000. What is left is 8 years. This gives us a new annual depreciation amount of $19,375. That would be the amount we would post to our depreciation expense and our accumulated depreciation. Companies need not disclose changes in accounting estimates made as a part of normal operations. So things like their bad debt allowances, inventory obsolescence, unless these changes are material. However, when changes of estimates are going to affect more than one period, such as the change in the service life of a depreciable asset, companies need to disclose the effect on income from continuing operations and related per share amounts of the current period. Next, we're going to talk about a change in the reporting entity. Reporting a change in a reporting entity requires restating the financial statements of all prior periods presented to show the financial information for the new reporting entity for all periods. The financial statements of the year in which the change in the reporting entity is made should describe the nature of the change and the reason for it. Examples of a change in our reporting entity are presenting the consolidated financial statements in place of statements of individual companies, changing specific subsidiaries that constitute the groups of companies for which the entity presents their consolidated financial statements, changing the companies included in combined financial statements, and changing the cost, equity, or consolidation method of accounting for subsidiaries and investments. Now that we've really looked at changes, we'll stop this particular video and we'll talk about errors in the next video.